The investment landscape is changing. Investors are increasingly incorporating environmental, social, and governance factors into their decision-making. This shift towards responsible investing is driven by a growing awareness of global challenges like climate change and social inequality. Investors are looking for companies that not only generate profits, but also demonstrate a commitment to sustainability and ethical practices. However, this surge in ESG investing has also attracted a less virtuous trend, greenwashing. Greenwashing is the practice of making misleading or unsubstantiated claims about the environmental benefits of a product, service, or company. It's a way for companies to capitalize on the demand for sustainability without making genuine efforts to reduce their environmental impact. Greenwashing can take many forms. Some companies make vague or exaggerated claims about their environmental performance. Others highlight minor eco-friendly initiatives while downplaying their overall environmental footprint. This deceptive practice undermines the very purpose of ESG investing, which is to channel capital towards a more sustainable future. Greenwashing is often subtle and difficult to detect. Companies have become adept at using marketing tactics to create an illusion of environmental responsibility. They employ carefully crafted language, appealing imagery, and strategic partnerships to present a green facade. One common greenwashing tactic is green labeling. Companies slap eco-friendly labels on their products without meeting the necessary environmental standards. These labels often lack third-party verification, making it difficult for consumers to assess the validity of the claims. Another tactic is selective disclosure, where companies highlight a single environmental initiative while concealing their overall environmental impact. This creates a misleading impression of their sustainability performance. Greenwashing thrives on ambiguity and lack of transparency. Companies exploit the complexity of environmental issues and the absence of standardized reporting frameworks to mislead investors. They use technical jargon and obscure metrics to make their environmental claims sound more credible than they actually are. The motivations behind greenwashing are complex and multifaceted. In many cases, it boils down to a simple equation: profit maximization. Companies see the growing demand for sustainable products and services as a lucrative market opportunity. They engage in greenwashing to attract environmentally conscious consumers and investors, hoping to boost sales and increase their market share. Another driver is reputational risk management. Companies are aware of the growing public scrutiny of corporate environmental practices. They fear that negative publicity about their environmental impact could damage their brand image and alienate customers. Greenwashing becomes a way to deflect criticism and maintain a positive public perception. Furthermore, greenwashing can be a way to preempt stricter environmental regulations. By appearing environmentally responsible, companies hope to avoid government intervention and maintain their freedom to operate without additional constraints. Identifying greenwashing requires a critical eye and skepticism. Look beyond green marketing hype and delve deeper into a company's environmental track record. Scrutinize company claims. Look for concrete evidence like third-party certifications and independent audits. Are the claims specific and measurable? Research a company's track record. Past performance can indicate future behavior. Section 5. The high cost of greenwashing. Impacts on the environment and beyond. Greenwashing is not a victimless crime. It has far-reaching consequences for the environment, the economy, and society as a whole. By creating a false sense of progress, greenwashing allows companies to continue with business as usual, delaying the necessary transition to a more sustainable future. One of the most significant impacts of greenwashing is the perpetuation of environmental degradation. When companies get away with misleading environmental claims, they face no real incentive to reduce their environmental footprint. This leads to continued pollution, deforestation, and resource depletion. Greenwashing also undermines the credibility of genuine sustainability efforts. When consumers and investors lose trust in environmental claims, it becomes harder for truly sustainable companies to differentiate themselves. This can stifle innovation and discourage companies from making genuine efforts to improve their environmental performance. Section 6. Transparency as the antidote, the role of regulation and disclosure. Combating greenwashing requires a multifaceted approach. Governments, regulators and industry bodies all have a role to play in creating a level playing field and ensuring that environmental claims are credible and verifiable. One crucial step is the development of stricter regulations and standards for environmental marketing. Clear guidelines are needed to define what constitutes greenwashing and to establish penalties for companies that engage in deceptive practices. Governments can also incentivize genuine sustainability efforts through tax breaks, subsidies and other forms of support. Another important measure is to promote transparency and disclosure. Companies should be required to report on their environmental performance in a standardized and comparable manner. This would allow investors to make informed decisions based on reliable data rather than relying on marketing hype. Section 7. The investor's role, due diligence and impactful investments. Investors play a crucial role in combating greenwashing and driving sustainability. By demanding transparency and supporting genuine sustainability, investors can promote positive change, engage in active ownership to influence corporate policies, use shareholder power through dialogue, resolutions and proxy voting, support organizations exposing and combating greenwashing, align investments with values by choosing funds prioritizing genuine sustainability. Section 8. Conclusion. Towards a future of authentic sustainability. The rise of ESG investing presents a significant opportunity to channel capital towards a more sustainable future. However, the pervasive threat of greenwashing casts a long shadow over this promising trend. By understanding the dynamics of greenwashing, recognizing its various forms, and taking steps to identify and avoid it, investors can ensure that their capital is truly supporting a more sustainable and equitable world. The fight against greenwashing is not just about protecting investors from financial risks. It's about safeguarding the planet and securing a livable future for generations to come. It's about demanding transparency, accountability, and genuine action from corporations. It's about ensuring that ESG investing lives up to its promise of driving positive change and creating a world where both people and the planet can thrive.